So Liana, okay, we're looking at potentially the last big boom for this decade, all right? So 2025 to 2030, the last big stimulus is going to be this rate cut, and you've sort of coined it as the rate cut boom. Can you sort of unpack that for the audience today and just explain what is actually going to happen and the dynamics at play?
Yeah, so rate cut, just the anticipation of rate cut, it's already actually making moves in the market. So if you look at this graph, what you can see are two things. When interest rate goes up, it's not necessarily true that property prices will come down. So historically, if you look at periods where interest rate did go up, it really depends on the underlying supply and demand. If there's an underlying shortage of housing, there will be a period of shock, and then people will just go back to their normal lives, which is there's an undersupply. Well, I got to pay more for my properties if I want to get into the property market.
Yep.
So we've seen that time and time again. So this cycle is no different. So if you look in 2022 to 2024, yes, interest rate has gone up quite significantly.
Yeah, so the green line is the interest rates,
Yeah.
yep.
And the blue line is property prices. You can see the property prices, there was an initial shock. However, they rebounded very, very quickly.
Yeah.
Now, the second thing you're going to observe is that when interest rate goes down, property prices generally go up.
Yeah, so Leon, there's a good example here in 2008, just after the GFC, the rates got to their peak and then they dropped. And then you can see in the blue line, the property prices came off a loss, one of the only losses. In fact, there's very few losses here in terms of the property market. It's gone from minus 5% growth up to above, almost 15% growth in 1 year.
Yeah. So with the rate drop, the property prices rebounded very, very quickly. So historically, it's always been the case that when rate drops, it always stimulates the property market.
Yes.
So in this case, we've got the double whammy where, because there's already an underlying shortage of housing that's already pushing property prices up across the country. On top of that, you're going to get this rate cut incentives as well,
Yes.
which just means people can afford to buy more. So what we're hearing from the market, and also what we're just hearing from our members and people that are potential members, is that they're not like, they want to buy property.
Yeah.
It's just about how much they can afford.
Yep.
So if you allow them to afford more, they would just, buy more and better properties.
Yeah, if your borrowing capacity is stuck at 700 grand, the rate cuts come through, now you can borrow 850, where you've got more to spend, there's more people in the market. And Leon, there's a lot of people that might only have a borrowing capacity of 400 or 500, couldn't get into the market, don't want to buy in a regional area, they want to come back to the capital cities. With these rate cuts, they're now going to be able to get into the market. So there's going to be a lot of additional demand in the market.
Yes, and I think in this case, there's not going to be a lack. Just the fact that we're anticipating a rate cut is already going to stimulate the market. We're already seeing that happening across the market because housing prices has been steadily climbing anyway, but because people are actually anticipating rate cuts. So if you look at the stats about investor loans, the proportion of investor loans in the last quarter is actually 38% as compared to about 30% a few years ago. So the amount of investors that are jumping into the market has been increasing over the last couple of years. So that's already significant, even though interest rate is at a high at the moment. Yeah.
That's right, Leon. I think we hit a peak of $11.5 billion of pre-approved loans for investment property in Australia in one single month, which is an Australian record.
Yeah.
So investors are flocking in as we speak. And Liana, you say that window's about 150 days. So in green here, we've got the cash rate. Now, this cash rate, you're forecasting that potentially we can see rate cuts beginning early next year.
Yeah.
And whether they happen in sort of, February or June, around about that time, even the anticipation of that rate cut. But once those rate cuts start coming down, then we're going to start to see that property price growth come through. And as you're saying, I think the warning to everyone is that this price growth, and you can see here on the blue lines, when the growth comes, the growth is not coming like this. The growth comes very steep and sharp, and it happens in a very short amount of time.
Short amount of time. So we've seen that time and time again. So you don't want to actually
get caught out, right?
Yeah, you want to set yourself up before the growth phase actually kicks in, the massive momentum kicks in. So when we say approximately 150 days, we're sort of predicting the rate cut could come as early as February next year, but it could be, the next one or the one after. So if that's the case, you do want to position yourself before that.
And in terms of what the banks are predicting for rate cuts, CBA is saying February, ANZ is saying February. So Liana, that window between now and February, 150 days. This is really the time to get into the market.
Yeah.
Imagine your borrowing capacity now is just 700,000, 600,000. By May or June next year, high quality properties in capital cities and well-located areas will be out of that price range, potentially forever, okay? So definitely do take the time to figure out if this is for you. You've got a very short window of time. And Liana, the earlier you get in, because we're already starting to see some price movement in Melbourne.
Yeah,
okay, very small now.
So October is actually Melbourne's outperformed every other capital city in capital
It's happening already.
So it's happening already. Yeah.
All right.